Hi, Karl. Thanks for coming. Welcome to our podcast today. Please introduce yourself.
Yeah, thanks for having me again, Donnie. So my name's Karl and I'm from an accounting firm called Karl Group. So we are basically, our clients are small businesses, mum and dad investors.
Yep.
We cover everyone from individuals to trading entities to investment entities and self-managed super funds as well.
Yep. And where are you based, Karl?
We're based in the Wollongabba area.
Yep. Is that on Logan Road?
On Logan Road, yeah.
Yep. Perfect. So if you guys need to Google, it's called Karl Group.
Karl Group.
Karl Group. Fantastic. So some of the questions that I like to cover today, Karl, is tax-wise.
Yep.
So the first question that I like to, touch on is in terms of depreciation. How does the small businesses save on depreciation?
Yeah, sure. So I guess from a tax deductible point of view, depreciation is one of those things that is really good from a tax outcome. So if you go and buy a certain asset, the government allows you to write off that asset to a certain extent. The rules are changing for small business from 1 July.
Yep.
So they're reducing the threshold from basically an unlimited threshold down to 20,000. But depreciation is basically just claiming the cost of an asset you use in your business.
Yep.
To help reduce some tax.
So when you're talking about assets, you're talking about plant and equipment as well?
Yes, plant equipment, yes. So everything from motor vehicles to equipment to computer and tech items.
Yep. With depreciation, is there any kind of difference for buying a motor vehicle for taxation benefits purpose? Is there any kind of difference between buying a brand new vehicle and an established vehicle?
There's actually no difference really, because the tax system allows you to claim whether or not it's brand new or secondhand. So, so it doesn't really matter as long as you keep it below, if possible, keep it below the certain threshold where, which is about 64,000 at the moment.
Yep.
Now there are been some changes with electric vehicles or EV vehicles.
EV, yep.
So with a normal vehicle, you've got to then deal with any fringe benefits tax on any private use. So the government said, look, if you get an electric vehicle, then you don't have to worry about this FBT on the private use. Yep. So they're exempting it. So that's another good reason if you're looking at an EV, and it's going to be a bit for business purposes, is to look at buying that under the business.
Because I think most of the EV these days, the government considering actually putting less tax on those particular cars, so the car manufacturer can sell a little bit cheaper. Yeah, in the olden days, you're talking about 60,000 plus, which not many people can afford it, especially like talking about Tesla. Whereas these days, I think they were talking about all the other brands like Toyotas and all the other manufacturers have been put out somewhere around between 40 and 50, which is much more user-friendly.
Yeah, definitely.
The other segment that I like to touch base on is in terms of capital gain tax. Just say for an investment, like for myself, when we're buying property, how does capital gain tax works? And is there any other way to kind of like try to minimize the capital gain tax?
Yep, sure. So capital gains tax applies whenever you sell an asset such as property or shares.
Okay. Yep.
So if you sell something at a profit, or you've sold something higher than what you bought it for, that triggers a capital gain event. Sometimes you can sell something for less than you paid for it. That'll trigger a capital loss event. So I guess from a capital gains tax point of view, it does depend on who owns the asset as to how it's taxed. So individuals and trusts get a 50% discount from capital gains tax if you hold the asset for 12 months or more.
Okay.
Now, companies don't have that 50% discount.
No.
So it's just something to be wary of if you're looking at potentially buying something that might have a potential future capital growth. Is to structure it correctly from day one.
So just say, for example, if I buy a property, say from today, and I demolish the property and rebuild a brand new property, how am I going to basically save the capital gain tax? Like, do I classify as a place of residence, or should I basically place that as or use that as a part of investment when I sell it?
Yeah, sure. I think if it was always an investment property from day one, and just say there's an old house in there and you knock it down, build a new one. Once it's finished, you put tenants in there and continue renting it. Then that property will always be subject to capital gains tax. But assuming you would hold that asset for more than 12 months, you will get eventually down the line that discount will apply. But it's always about keeping good records, because all those construction costs, for example, they're all
renovation.
And all renovation costs are all captured or should be captured when you do the capital gain calculation at the end. So it's just all about keeping good records, really. But anything to do with that renovation or the capital improvements or anything like that is just keeping good track of all those sorts of things. So.
If I would sell, say, build and sell within a year, what if I sell it, say, in the next 5 to 10 years? Would that depreciation or capital gain tax would help?
Yeah, I mean, the discount will always be there as well. So if you do something where you're buying something and you're selling something within 12 months, and you still happen to make a decent gain, you're not gonna get that discount. So you're gonna be paying more tax there. If you are constantly buying property, renovating and selling, the tax office can view that as something which is not capital gains. It's more like
business-wise.
Property flipping.
Yep.
And that sort of stuff. So in that scenario, you don't get the 50% discount if you're doing it as a business. So
no threshold.
Yes. So if you're doing it, if it's one-off, or you're doing maybe
once every 3 years or something,
then maybe there's an argument that you're not doing it as a business. So but every case is a little bit different. But generally, if you're holding on an asset for sort of long-term purposes, then that's normally on capital account, and the discount will normally apply. So,
just say, for instance, we've got a property that we can build up to 20 units or apartments. How does capital gain tax works if we sell it like individually apartments over the years, or selling as a big numbers?
Yeah, I think when you start talking about a development like that, and you can say put 20 units on a block, that can change the way that the whole transaction will get taxed.
Oh, I see.
Yeah, so they can view that as actually a business,
more like a developer,
rather than just a mum and dad investor. So the size and the scale of that can be different, and potentially GST could apply in the sale.
Oh yeah, true.
Yeah, so that's a bit of a thing to be wary about. I think if you're going to go into something like that, that's normally where you get all the advice properly documented up front, and then knowing what the tax outcomes, what potentially tax outcomes will be if you're doing a development like that. But it's like, that's almost like a different kettle of fish altogether.
Is it hard to create a what do you call it, like a family trust or some sort of trust that you can save tax benefit, later on down the track?
Yeah, you can potentially. I mean, family trusts are good in the way that they're flexible with how you distribute income from there. So if you're using it to invest, good from a capital gains tax point of view with the discount. And the family members potentially can benefit from the trust itself.
including your child, your
potential children or relatives can be all part of your family trust. And but depending on how old the kids are, if they're over age of 18, they could potentially be used in some sort of tax effective manner. If they're under the age of 18, there's not really any scope to use minors, but once they're over 18, there's a little bit more room to fit them in. So trusts aren't overly difficult or to create. It's all about understanding what you want to use the trust for. I mean, because you can use trusts to carry on businesses. You can use trusts to invest in. So, and often we don't like to mix the two up.
Yeah, certainly.
So one, if a trust's going to invest in, well, you don't want to use that same trust to carry on the business.
True.
So it's just about understanding what those goals are and then trying to structure it correctly. But trusts are used widely throughout Australia. Nearly every one of our business clients would have some sort of form of trust somewhere. So they're a really good form to invest in, to carry on the business in. So
I would assume that for a local resident compared to international investors, what would be the difference in terms of tax legislations and benefits and that sort of stuff for an international citizen?
Yeah, actually they're quite different, the rules. So a non-resident who buys, just say, property here in Australia or buys shares here in Australia. So how resident individuals will get that 50% capital gains tax. Now, foreign residents do not get the 50% discount. So the government removed that back in, I think, 2012. They said, look, up until that point, everyone had the same rules, but then they decided, look, no, foreign residents just don't get that discount. That's one thing. Another thing also is that with foreign residents, if they want to go and buy property in Australia, they actually need to get approval from the foreign investment board. So it's not just a matter of just turning up and finding property you like and signing a contract. There's a bit of things to go through to make sure you get approved first. So
you need to go through with all the criterias and legislations and so forth.
So you just need to get a lawyer who's up to speed with all those rules and help them navigate through it to ensure that you get the green tick before you actually buy property here in Australia.
So in terms of stamp duty, is probably would be higher than some of the local resident around here, wouldn't it?
Yes, generally, same with tax. Other things like stamp duty and some of those other things are generally higher for foreign residents. So
does capital gain tax would apply to them as well, like higher or lower or similar? Or?
So the rate of tax for foreign residents are higher than individuals as well. So no tax-free thresholds, so they pay tax from the first dollar, whereas you and I wouldn't pay tax on the first 20,000. So for example. So the rates of tax are definitely higher. That doesn't necessarily stop investors from investing in Australia, but it just means if they're making money, they would generally pay more tax than what a local person would.
So in summary, is there any kind of recommendation that you would like to let the people know out there that, hey, these are the recommendations for an investors or a small businesses looking at buying property in terms of setting up a trust, keep records and that sort of stuff for either a new construction or a renovation?
That's a good thing. I think really the main message is really getting the correct advice right from the outset. And obviously, sometimes things can change. So you might go into a certain transaction thinking that it might pan out this way. And if things change, things can change. But if you sort of try to at least understand what the objective is of the investment or the business, then it's getting the structures correct. it's really expensive down the track if you realise it's not the right structure to try to potentially restructure. And I've seen a lot of those in the past where, you know, certain things haven't been structured correctly. To unwind things and to get them right, then comes with a cost, which it's not good when you've got to tell a client, well, it's going to cost you X amount of stamp duty to fix it, or this much tax to fix it. So getting the advice, talk to your accountant regularly about things. There's nothing worse than doing something and then telling your accountant when it comes to tax time, and then you may have missed the boat about a certain aspect of that acquisition that may have been missed. So, and just probably another thing is just to ensure you keep good records. With everything. That's probably the main thing. And if you're keeping good records, at least your accountant has the whole picture. You've got all the evidence to show if you have ever asked or audited. So,
is there a time frame that you should keep the records by certain time frame, certain date, or?
Yeah, look, generally for things like contracts or anything to do with a property, if it's, for example, an investment properties, to keep the records somewhere really safe, because some of those documents you will need to keep, for a number of years after you've sold the property. Now, that could be, many, many years down the track, sometimes even decades. I was dealing with a capital gains event last year, and it was for something that happened in the 80s. So now, luckily, the client had kept a lot of the original things. So, it's a matter of keeping those things. Your general year-to-year expenses, your rates, and you need to keep those for a few years.
5 to 7 years, maybe? Or?
Yeah, look, I say I recommend keep it for 5 years at least.
Minimum,
and just all your important documents, just keep them safe somewhere forever until, years after you've sold it, then you can safely destroy it at that point. So
just say, for example, if someone doesn't have an accountant, is there a website from the government that they can actually seek or go to find out those specific details?
Look, there's a lot of information online. The ATO have a website. And there's content on there. I would just say it's good to go on there and have a look. But there's one thing, the ATO giving you that information, but if you don't understand it or you don't interpret it properly, that's where sometimes people can come unstuck.
It's too general.
Yeah, often it is, and often it doesn't. It's not taking into consideration your whole circumstances. So, whereas if an accountant's looking at everything from a holistic point of view, if you're just on the website, you're just honing in on one little aspect.
Oh, I see.
You may miss
10 other pieces.
Yeah, absolutely. You're just looking sometimes with a bit of tunnel vision and looking at just that, whereas there could be many other things happening around there which may impact on what you're looking at. So, but look, there is information there as a good starting point or a reference point. But it's still always good to seek that advice, because it's very important to make sure you're across everything.
Anyway, thank you so much for coming to our podcast, Karl.
Yeah, no worries.
Appreciate your time, and all the best.
Okay, thanks very much.